Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, which is right over there, and your host for about the next 20 minutes here on Options Guide TV. All right, well, we're in the middle of it, of a lot of it, right? We are looking at very well, I don't know, volatile situation in that just a lot has happened over the week. And we're seeing actually the VIX index come down, and that's mainly because the markets are going up. We have a plethora of earnings kicking off on the Meg 7 with Netflix. We also have Apple announcing on the 30th. Then we get into February, and we have Google, and we have Amazon. And I'm going to stick with Amazon this week. I'm going to do something a little bit different. I always have mentioned many times that I like the fact that Amazon usually announces on a Thursday, and then you have all day Friday for your option contracted trade. Now, this time around, a lot of times I'll do a butterfly because of that, because you have the earnings announcement and you have a high price stock, $234. And you have all this juice that's in these option contracts, and all that juice has to go away the very next day because expiration is here. I should clarify that. I think it's obvious, but I don't want to make sure that you understand that. So we will probably go into Amazon and Google, because I think I have Google down on that same day, and we will look at doing some type of butterfly, something around that earnings a date where you have an event that is just going to expire. But on Amazon, I kind of like to just get long Amazon. I think Amazon, even though, one of the higher valuations inside the Meg 7, Apple's getting beaten up recently, interesting enough. So maybe their valuation is coming down a little bit. But with Amazon, I want to buy a long call option, and I don't want to pay the juice for it. So I'm going to do a diagonal spread, and I'm going to try to help pay for that option contract. So this week, I'm going to go out to the February 14th expiration, and we can run over to the Tradier Pro software. And this is going to be our main trade for the week. This is the one thing we're going to look at is getting this trade on in Amazon heading into earnings. With the stock at 235, if we look at the actual earnings date, let's go back to that day and just look at what the long straddle would be. Okay, February 7th is the Friday. They announce on Thursday after the close, February 6th. If we buy the long straddle, the expected move, I'm going to buy the call for the most at the money, buy the put for the most at the money, is $16. So I always want to keep that in mind, that if you're going to be doing something around earnings, it's good to know what the over under is. And in my mind, and that's a betting term. Like if you're betting on football, you want to bet how many points will be scored total between both teams. And either you can choose over or you can choose under. In the Amazon world, or in the earnings world, all these monies come in and they are buying options. Some people are buying, some people are selling. That helps set the price based off of demand and gives you an implied volatility. Well, so because of that, a lot of people consider what you pay for the long straddle to kind of be the over under after earnings. And if I'm doing this trade, I want to try to stay within that potential move. The marketplace thinks it can move 16 points. Now, remember, it's not any regard to direction. Then I want to choose strikes that go along with that. If I'm going to be bullish on earnings, I'm going to buy something that's within that 16-point move, because I want the stock to go to that strike and go beyond. And so I'm going to look at keeping that in mind, that that's on the 16th, and that's 16 points, and that's as of that February 7th expiration. So we're a little bit ahead of things right now. You'd usually look at that, more closer to the actual earnings date. But keeping that in mind, I'm going to go out to the February 14th, 16 points is what the expected move is for the prior expiration. So 10 points I'm okay with. So 10 points says that yes, the marketplace could, if it's perceived that you have an earnings that is coming, if it's perceived that that is a good thing, right? It can at least go beyond that according to the expected move. All right. So $5 I'm okay with. We're paying right now, as far as implied volatility, 37%. Historical vol isn't that far away. So we're seeing a little bit of a pump up in implied volatility. So by buying this option contract, and let me delete the rest of them, we might be able to get out prior to the expiration date. The stock is up 1.75% today. It's up $4. If we want to ride it into earnings, no problem. But at this point in time, I don't mind buying this option contract because I do think implied volatility will increase from this point as expiration approaches, especially considering that the historical vol is around 35%. And we're seeing the shorter term options ahead of earnings trade at about a 28% implied volatility. So this isn't an outrageous vol to pay for Amazon going into the earnings date. So you're paying $5. You're going to get 23 days till that expiration. And then I want to sell a shorter term option against it that's going to expire prior to the earnings date. Now, here's the concept here is that when I get to earnings, if I do want to remain just long this call and I want to ride it through earnings, I want it to be cheap. I don't want to pay $5 for that trade. I don't want to pay 37 vol points. So I'm going to sell something to try to offset it. And I like the concept of selling something that is, you can either sell the same strike, the 245 strike, and just hope that it doesn't get to 245, up 10 points by that expiration date. Or I like to go a little bit out of the money. So the 245 is there. I don't mind selling the 247.50 and bring in 74 cents. 245, if we keep it real, if we go below that, then it's a short call spread. And there's an actual requirement because the strike that you would be assigned at is below the strike that you'd actually buy it at. So we either want to buy the 245 or the 247.50. I'm going to do the 247.50. That's a decent amount. We're going to bring in 68 cents, and that's going to help us with our vol premium a little bit. So if we do this trade, we hope the marketplace will drift towards the 245 strike. That's a good thing right now because we're long a call option. We do not want it to go beyond the 247.50. And if you notice here, we're right at about a 13 delta based off of the stock being at 235 or fairly close to that, 234.23. So there's only about a 13% chance of this one getting assigned. And that's prior to the earnings. And that's a good thing. We don't want to be assigned, but we would like it to come up this direction if we could. And our midpoint then, this one should be a buy. This needs to be a buy to open. It's $4.12 or $412 for every 1-by-1 diagonal spread that we are doing. So speculative in that we're buying it out of the money option. Implied volatility, don't mind in that on the shorter term option, implied volatility should be waning and you're going to have a large rate of time decay over the next 9 days. If the stock starts coming up, we don't want to get it beyond the strike. Let's say if we woke up tomorrow and the stock was at 250, right? In that case, we're just going to probably close out the whole trade because we got pegged on our short option contract. We would be profitable on the trade more likely than not. And we would just get out of the trade and take whatever profit that we have and move on and be sad that we actually sold the 247.50 call. Our whole goal here is that that expires worthless, and that makes our long option here much cheaper. Yep, and at least it's showing me green, and this one's red. Okay, so that's really it. That's going to be our paper trade for this week. Netflix knocked it out of the park. They're up 10% today already. So things are kind of looking good for the mega cap tech. Interest rates have kind of been an issue a little bit, but the only stock right now in probably the whole marketplace, really, it seems like, that's really struggling is Apple. You have the small caps, which we have a long straddle on in the small caps, and I personally have it on in my account. Had a great run up after the news, and now it's coming back down. We're losing about 0.5% in the Russell 2000 index, so that one's still something to keep an eye on. But I have that trade on in my own account. And then last week we went out and we looked at a skip strike butterfly in the SPX that ended up getting pegged, and I had that position on a little bit higher in my account, but I ended up getting forced out of that one too. So the markets have been tough to trade. We also have an interesting pattern kind of forming in the SPX. We might be breaking out a little bit to the upside on it, and I just want to see if that plays out. And then maybe this Friday we'll look to go back to doing our weekly SPX trade. But at the end of the week, we're definitely going to be doing something in Amazon or in Google, because we usually just do an earnings play around those two underlying stocks. So let me take this over to the what if calculator, and we'll take a peek at that at that calculator, I guess, in general, or what the profit and loss graph looks like right now. So it's really a long call spread. The reason why you would call it a diagonal is that if you were down on the floor of the Chicago Board Option Exchange back in the day and somebody walked into the pit and said they wanted to buy the February 14th 245 call in Amazon and sell the January 31st 247.50 call in Amazon, and give me a net price for that, a net bid and a net ask. In that instance, the market makers on the floor would have to look at the quote boards diagonally. They would have to look at the one expiration here and the other expiration here. And that's hence where diagonal comes from. And sometimes you'll hear horizontal, and sometimes you'll hear horizontal means that you're on the same strike line, but you also just look at the boards horizontally to get to two quotes. And then the last one is, a vertical, and you hear that used more often for just a bull call spread. And in this instance, it's the same concept of a vertical in that you're paying a net debit for it, but you are going to sell the option contract that expires before earnings, and you're going to buy an option contract that's going to expire afterwards. And this is what the profit and loss graph looks like by that first expiration date. We would be up on the trade. Here's the zero line. It's implying that if everything stays the same, and you got to kind of keep your focus right over here, this will show you at expiration, we would be up about $400 or $500 on this trade if we could get it up to that level. So we're not hurt if it pegs and it moves all the way up to the 250. In this instance, we're showing up about 382 or so. We would be fine on the trade if that did happen, but that's not our goal of our trade. What we'd like is for the stock to come up to the 247 level, expire somewhere in this range, allow us to be long that option contract, decide if we want to ride it into earnings or not, and get that option contract for a little bit cheaper price than paying all that implied volatility premium heading into that earnings report. I like to do diagonals around earnings. Sometimes I'll even go a little bit further out. So you start with 30-day option contract, and then you really start getting that bumped up in implied volatility. But at this point in time, seeing that it's still trading at a couple of vol points above where the historical at, the front month is a little bit further than that. I should say the February 7th, which has the earnings report, is at 42. But I do think we can definitely start creeping higher on this. And I don't mind being long that option contract, and we might get out before earnings if we get another few more days like this in Amazon heading into earnings. We're up 1.5% on the day. All right. It's short and sweet this week, mainly because all of our trades played out last week. Everything we looked at. IWM is still rocking and rolling. It's down $1.57 today. It was up a few dollars. I really want, and I should just kind of look at that chart, by the way. And then I really wanted it to close above 230 yesterday. So we got a minor breakout. And I have a fairly big position on in this. So right here, if you go back and kind of look at these levels, this is where this gap down was, and we're kind of dancing with it, and then we're broke out to the upside. If we could break out above and get up to this level on the IWM, this would be a really good sign. If we could start breaking out above where this gap down happened, and that would be right about here. And I think that was the Fed meeting, actually, where the Fed became a little bit more likely to not do 4 or 5 rate cuts this year. Basically that drove the small caps down. So now we got the 10-year coming back off a little bit. We still don't know all the policies. I still expect a lot of policies to come off. Talked about the tariffs. At least doesn't look like they're going to be beating up on Canada anytime soon. So all of these things are going to start playing out this week and next week with a lot of the executive orders that the new president actually put into place. There'll be headline news about it. So hopefully we can break out above it. Like I said, this right here was an important level, right at 230, and we couldn't quite get there. It's right at the bottom of this candle and kind of fill in that gap. But I didn't mind seeing that we broke out a couple of strong days here, and we kind of had a little bit of a breakout in this near-term muddy of the waters. Bounced off the 50-day moving average, been pretty strong since then. I don't care which way it goes. I just want it to go. So the best solution here is if we get to break out above that 230 and we go back up and test these type of levels. All right, that's it. I don't see any questions. Yep, that's going to be it for today's Options Guide TV. We'll come back on Friday. We'll look at what we're going to do in the SPX. And then next week, we've got a very busy week. We'll address a lot of the Mag 7 earnings reports and come up with a few trades for those stocks. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.